What is the real effect of student loans when it comes to buying a house? Hi, this is Clint Stitser with the Stitser Real Estate Group. And before we begin, I want to call your attention to two links on our blog. First, if you're interested in buying or investing in real property, please click on the Search Now link. Second, if you're interested in selling real property, please click on the Property Valuation link. We were at an economic presentation the other day and the economist made a point. He said, hey, I really don't believe that student loans have a major impact on people's ability to buy a home. And it struck me as interesting because I know plenty of people who have lots of student debt and it's a major concern of theirs that their loan payments are going to restrict their ability to buy. In fact, I had a client the other day who was trying to choose where they could buy a house because they wanted to make sure they were near where their son buys. However, they said their son needed to save up 20% and he had some student loan debt and they just weren't sure how it was all going to fall together as it pertained to his affordability. So then I really looked at this chart that the economist presented, and what we see here is we see the average student loan debt in the blue line and the average student loan, or the median student loan payment on the green line. The reason the average is higher is because when we do averages, the higher percentage of people who have the higher payments pulls the average up, right? So those are usually the people with professional degrees, our doctors and attorneys. And the economist presentation, he says, hey, the doctors and attorneys, when they start their career, they've got a higher income and they're able to offset that higher loan payment and still qualify to buy a house. We really want to focus on this median number. And this median number is $200 a month. Yes, $200 a month is a lot of money, but it's not so much that can't be overcome and still qualify under today's debt to income qualifications using the low rates for a median level priced home. Or it's not so much that someone couldn't get a friend or a family member to co-sign and overcome that $200 implication on their debt to income ratios. And I continued to think, but I said, yeah, but there's still a lot of thought about people wanting to save up more money so they could have a bigger down payment and a lower payment that's a little bit more sustainable for them into the future. And so I decided to run a little bit further numbers on that. To set the stage, let's take into consideration what happened in 2016 in the Northern Nevada market. We had an annual increase in median price of 5%. So what does that mean? Let's say a home was $300,000 at the beginning of 2016. At the end of 2016, it was approximately $315,000. There's a video I recently made on the expectations for 2017, and the consensus is single-digit price appreciation. Let's just call it 5%. So that $300,000 home in 2017 will turn into $315,000 by 2018. Okay? So let's just set that as this one piece of information as we move forward in this presentation. The other thing to take into consideration is long-term affordability. Relative to all the way through the 90s and the early 2000s, homes are still more affordable when it takes into consideration the price of the home, a person's median income, and interest rates. We are substantially more affordable than we were in 1990, even than we were in 2001. So that kind of builds a case for now being a good time if a loan product is available for you or someone you know who has college loan to pay for. The next thing we want to look at is credit is generally very hard to get. Now, this video is about showing that people who have student loan debt can actually get a loan, and this slide might seem contradictory because I'm saying, hey, credit's hard to get. But the point I'm making here is, yes, credit's hard to get. It's getting easier, but very slowly. But this chart proves that the people who are getting a loan are proven stable. They're proven as sustainable loans. What does that mean? It means you're entering a market where everyone else has proven themselves up and it's built on more stable foundation, rather than what we saw in 2004, 2005, where anyone can get a loan without having to prove much of anything. Okay. The last thing I want to consider is the cost of renting versus the cost of owning. And this is a really simple chart. It's from Freddie Mac, the government-sponsored entity that buys loans, and it's based on a $200,000 home. And if we say, let's say you have 5% saved up on a $200,000 home, which is $10,000, versus waiting to be able to save that extra $30,000 and having $40,000 to put down. Well, your loan amount is going to be $190,000, and at today's interest rates, approximately 4.5%. Your principal and interest payment is $962. Because you only put down 5%, you will have a mortgage insurance premium, and this chart estimates it at 0.51%, giving you a total payment of $1,043. Now, this does not include taxes and insurance, but that's another conversation. If you were to wait and save that extra $30,000, your total payment would be $810. So yes, you are saving $232 a month by waiting to save that extra $30,000 for a $200,000 purchase. However, the key question comes in is, are interest rates still going to be there in the time it takes you to amass that $30,000? And where did your money go in the meantime? So let's take a look at that. Well, the difference in payment over the 12 months is $2,793. Okay, so great. You're in the negative $2,793 when you get a higher loan to value loan. However, that price appreciation expected over the next 12 months at 4.7% creates the underlying value of the house an increase of $9,400. So even if you would have waited to save the extra $30,000, assuming interest rates stayed the same, yes, you would have saved $2,800 in payments. However, you would have lost $6,600 in appreciation of the home. And this is not even taken into consideration the fact that you get a tax savings on your mortgage interest and you get additional equity by paying down the principal on your loan. Over the course of time that you were saving an extra $30,000, if you were paying rent, that rent, it goes to the owner of the property. You get no tax savings and you get no additional equity earned in paying down your principal. So at the end of the day, the good news is that even if you do have student debt, usually the payments are low enough with today's low interest rates and today's median home prices that most people can qualify even if they don't realize they can. The other good news is that there are ample loan programs that are available with less than 20% down. What does this mean? It means that you can, if you have student loan debt or if someone you know has student loan debt, can qualify for a house with the underlying assumption that because credit is still relatively hard to get, that the people entering, even with lower down payments and private mortgage insurance, are still stable, sustainable loans. So that's my information on whether you have college loan debt and how that applies to getting a mortgage. If you or anyone you know wants to talk about that, has additional questions, we'd love to answer them for you. We can even refer you to a mortgage professional to answer those questions at a greater depth than what's presented in this video. This is Clint with the Stitser Real Estate Group, wishing you great success in all your real estate ventures.